South African consumer inflation slows to 4% in July, the lowest in 7 months. Zambia holds key rate even as inflation seen above target. Plus, Africa's largest wind farm now operational in Kenya as project lowers costs for Kenyan consumers. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwago. First, the market. Well, mixed sentiment was observed here in Africa at intraday amongst the markets we track here on the show. Nigeria and South Africa were looking good at intraday. The NSE index was up 0.07%. While the JSE index was up 0.59%. Egypt, on the other hand, faltered, down by 0.33%, and Kenya closed negative on Tuesday. And major Gulf stock markets fell at intraday as financial stocks dropped amid regional geopolitical tensions and ahead of U.S. Federal Reserve events. In the UAE region, sentiment was mixed. Abu Dhabi index fell 0.56%, with the United Arab Emirates' largest lender, First Abu Dhabi Bank, sliding 0.4%, and Alder Properties down 1.3%. Meanwhile, Dubai's index inched up 0.07%, led by a 1.3% rise in Emirates MBD and a 0.6% gain in Emma Properties. In other Gulf region, Qatar's index dropped 0.18%, snapping a 3-session winning streak. The Gulf's largest lender, Qatar National Bank, eased 0.3%, and Masraf Al Rayan fell 0.6%. In Saudi Arabia, the index dropped 0.75%, dragged lower by financial shares. RG Bank slipped 1%, and Riyadh Bank shed 1.5%. In Europe, stocks traded higher in the morning as investors wait minutes from a meeting of the U.S. Federal Reserve, while President Donald Trump suggested he was weighing measures to boost the world's largest economy. Well, let's bring in Conrad now for details. Good afternoon, Conrad.
Good afternoon, Chimi. Hello to everyone watching in Nigeria.
You're welcome, Conrad. Now, the financial markets are waiting for the minutes of the last Federal Reserve meeting to be published. But trading in Europe is very active anyway. Particularly in focus are the events in Italy, where the Prime Minister has given up his job and a new election is a possibility. How risky is Italy at the moment from market's point of view?
Well, Jimmy, I can tell you about a sigh of relief on the markets today. Milan, the equity market there, is pretty strong this Wednesday. And on the bond market, the Italian bond yield has fallen below 1.5%, which is the lowest level in around about 3 years. And what's even more important, the spread between the Italian and the German government bond, which is sort of indicating the difference of the German risk if you invest in Germany and the Italian risk if you invest in Italy. This spread has narrowed to around about 2 percentage points, which is much, much lower than it was at the time when, remember, the populist 5-star Lega government discussed with the European Union about its budget and about whether it was allowed to take as much debt as it wanted. This is when the markets were really nervous. Now there's a little bit of hope on the markets that we are going to see a new government in Italy maybe formed out of the 5-star and the establishment parties. That is the situation at the very moment. Of course, all kinds of different scenarios are imaginable. Maybe we'll see a real right-wing government in Rome. This is another scenario, with maybe the fascists returning to government. And this, I can tell you, would be something that wouldn't be very well received on the trading floors all over Europe.
All right, let's look at the corporate world. Chinese tech giant Alibaba is reported to postpone the listing of its stocks at the Hong Kong Stock Exchange. Now, this $15 billion listing was originally set for later this month, but the protests in Hong Kong have caused Alibaba to have second thoughts. Now, are the protests a real risk to the reputation of the financial center in Hong Kong?
Yes, they are. I have to tell you, Hong Kong had always a reputation of being a very safe place to do business in. Many Chinese companies from the mainland definitely needed Hong Kong if they wanted to tap international investors, and international investors who wanted to seek for Chinese investments really liked Hong Kong because the rule of law there was reliable. This doctrine of one country but two systems, you know, having Hong Kong being part of China, but independent, at least an independent judiciary and also an independent legal system. This was something that international investors found very interesting and very trustworthy. This is now, of course, in jeopardy. And companies like Alibaba are noticing this. They are saying, well, we better wait and see what will be the outcome of the protests, how the Chinese government, how the local government in Hong Kong handles the situation before we think about this, you know, float of our shares to the Hong Kong market. There are, of course, Shanghai and Shenzhen, two large trading places and financial centers on the Chinese mainland. But up until now, for international investors, those were not really the place to go. They're very highly regulated. They're very difficult to predict, very difficult to handle. Hong Kong was much better, but this, of course, is risking to go away now.
All right, let's look at an interesting development there in Germany, where the government will auction a 30-year bond with a 0% interest rate for the first time today. Now, last week it was Sweden coming up with 0% interest rate bond. Is this the new trend now? And what will this mean for the German government and those buying the bond?
Well, for investors buying those bonds, this means that if they keep the bond, they will not get any return for the next 30 years, not at least in terms of interest payments. With the negative yield, investors accept that they effectively have to pay money in order for the privilege to, you know, give our government here in Germany some of their money as a loan. That's, of course, a bit ridiculous. Which investors would like to do this? And it's quite likely that the investors going into those bonds now, buying them at auction when they're coming on the market, they're not so much interested in the yield they come along with. They're interested in the price of the bond, which is on the rise and which is likely to rise further, because everyone knows that the European Central Bank soon will return to the markets buying those government bonds. So this is basically what's driving investors who go for those negative yielding German bonds, the 30-year bond also coming to the market at a negative yield. What's really interesting is the second question you asked, the second implication, the one for the German government. At the very least, the Minister of Finance should refinance some of its older debt, benefiting from those super low yields. And of course, economists believe that it would be a good idea for the government here to spend more, to do something that our economy does not drift into a recession. We are often talking about how strong Germany's economy has been. We are seldomly talking about the dismal situation of the buildings of our schools, of much of our infrastructure. It needs repair, it needs investment, and the German government should do something. But we also have what's called the Schuldenbremse here in Germany. Schuldenbremse, break on new debt, and you know, the willingness of our government to return a balanced budget at any cost. So it's not very likely that Berlin will start spending.
Well, Conrad, let's just watch and see how that plays out eventually. Thank you for your time, Conrad. In Asia, the markets largely declined today after U.S. market pulled back overnight on recession fears. Some analysts said the sell-off in stocks pointed to deep-seated worries among investors. Japan's Nikkei 225 dropped 0.28%, retracing some of its earlier losses, and the Topix index declined 0.61%. In South Korea, the Kospi index erased losses to trade up 0.22%. Hong Kong's Hang Seng index was down fractionally as shares of Xiaomi tumbled 6.15%. The Shanghai Composite on mainland China was down 0.1%, while the Shenzhen Composite was down 0.27%. Australia's ASX 200 fell 0.94%, with a heavily weighted financial sub-index down 0.62%. Well, we'll take a break now, and when we come back, of course, we'll bring you an update on today's equities trading. Just stay with us.